Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. This video is going to be about Apple, everybody's favorite stock and computer and smartphone maker. I recently wrote an article about Apple, and what I tried to do in the article, okay, a little backstory. So I owned Apple for like almost 7 years. I bought it when it was really cheap in 2013. I bought it again in 2016, and then in 2018 when we had that big dip in the market, I bought more, and then I sold last year, almost exactly a year ago, because I thought it had gotten a little too expensive. And at the time, I mean, its earnings were only growing about 4% per year if you started in like 2012, and the PE was about 25. And there was some optimism, I think, about the earnings were going to pick up. And I think even toward the end of the article, sometimes when I write like bearish articles or articles where I'm selling my stock, I do like an opportunity cost analysis where I say, what's the probability, you know, that the stock is going to keep going up or whatever. And I think when I did my estimates for that, I assumed their earnings would grow at like 10%, which is exactly what they ended up growing for last fiscal year. But they just had a really good quarter, which was pretty much expected, I think. We knew they were going to have a good holiday season and everything. And my article came out a little bit before the latest numbers, which is what I'm going to cover in this video. But the point of my article was it's okay to sell these popular stocks that you've made a lot of money on. From my first purchase of Apple, I had made 500% when I sold last year. The stock is up about 80% since then. Okay, so the point of my article is actually, look, I reinvested that money, and a lot of it was reinvested during March, and I bought all these other stocks, and they did just as good as Apple did if I would have just kept holding it. So once you learn how to value stocks, all right, it doesn't matter if it's like really popular. It doesn't matter if you really love the company. If it gets expensive and you're pretty good at stock picking, you can take that money and go find a cheaper stock, and you can do really well with it. And my point was, a lot of the stocks that I bought are still undervalued. They could still go up more. Whereas Apple has gone up even more and it's gotten even more expensive. Now, on a positive note, the type of recession that we had ended up being really good for Apple. So, and they're also, they're always innovating. So I think the biggest risk of selling Apple is that they come up with some new product. I don't know what it is. Maybe it has to do with self-driving cars. Maybe it's something just nobody has really thought of, and they come up with the best new thing there, and then that is their growth driver that picks up growth from here on out. But if they don't do that, then the stock, you're just not going to make a lot of money from here over the next 10 years or whatever with Apple stock. You might do okay, or it could come down pretty easily, because when a company gets as big as Apple, it just becomes hard for them to actually grow earnings. I mean, it's a great company, but when they're trading at 40 times earnings, right now I guess it's more like 36. I'm glancing at it on Fast Graphs. But earlier this week, the stock was higher. You have to grow faster than 10% to really justify that. I mean, you really need to, at a minimum, you're probably want 15%. I mean, I would really want like 20% growth if I was going to pay a 35 PE for a stock. So there are other opportunities. I mean, I have a video out about Facebook today. If you just compare the two of them, Facebook's growing over 20%. They traded a PE of 22. Apple's growing, I think, about 11% now if we take their latest kind of big earnings boost. And you apply that to a 36 PE, I mean, there's just not really a contest. So, yeah, I think it's totally reasonable to, if you have profits in Apple, to take profits in it and to reinvest that in something like a Facebook if you want something that's just kind of similar, big tech type company. I realize they're not exactly the same, but same category of stock. So with that, I'm going to next look at the other sell suggestions and so that I've had on the channel. So we're going to see how they're doing so far since I said take profits. And these are companies that are high quality businesses, but they just got expensive enough that their future returns are probably not going to be that good. Okay? So nothing wrong with the business. It's just people have bid up the price too much. And usually you do well if you take profits when the prices are high and you buy when the prices are low. So I'm going to take a look at those and then I'll have a quick disclaimer and then we'll get into the actual metrics of Apple stock that I'm examining here. All right, before we get into Apple, let's just look at how some of these other sell suggestions that I've had this past month are faring. Again, these are high quality businesses, nothing wrong with the business, just that the stock price got too expensive. We have Nike, Intuitive Surgical, Estee Lauder, and Pentair. They are all down over 5%. And then if you look at, and pretty consistently, I would say too, if you look at the S&P 500, if we sold it or bought it on the same date, owned it on the same date, it would be down about 2% on average. These guys are down about 6% on average. So if you had sold those, you would have, or if you would not have sold those and held them, they would be down an extra 413 basis points from the S&P 500. So even though the whole market's down a little bit, these stocks are down a lot more. Okay, so and that's probably what we might expect from an expensive stock, and this trend could continue for a long time. So far, the take profits picks here are doing pretty well. All right, I have a short disclaimer, and then we're going to get right into the Apple analysis. Hello, everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Okay, taking a look at the Apple fast graphs here. Now, Apple went under a big transformation when the iPhone came out in about 2008, and they had a really big growth, earnings growth here up until about 2012 or 2013. I decided to be a little generous with Apple here, and I started this cycle in 2012. In 2012 actually had, let's see if it adjusts here, it had a huge like 60% up year. So this is me being pretty generous with Apple because the next year earnings declined, and whenever I am bearish, I try to be generous, and whenever I'm bullish, I try to be cautious. And that generally kind of helps as a good investing approach over time. So if we look at this time period from the time that iPhone sales had at least fully matured, I mean, they kept growing, but that initial kind of stealing business from BlackBerry and Nokia and Palm and all those guys, that was all pretty much finished with by now. So here's what we have. This shaded green area is their earnings, and as you can see, you can kind of see Apple's product cycles go up and down pretty consistently really here. Now their fiscal year ends in September, so at that point they had grown 10% over the previous year, and that's basically kind of what I had projected at the time. It was a little bit slower if you just use the historical numbers, but analysts were thinking 10%, and 10% is what it came in at, so they basically were right. Now after this latest earnings report, what they expect this year has grown a lot. I want to say this was like just last week was like 20% or something, and now it's 34%. So Apple had that big quarter, and it's like, oh, these guys are rocking it or whatever. So they're going to grow a lot. They think they're going to grow a lot this year. But then the next year they're looking at single digit growth. Okay. And what we're looking long term out 10 years. So that's what we care about. So this is kind of where we're at here, as far as what analysts are thinking. All right. Now, what I do is I take this trend that's going along here, and as you can see, it's a pretty consistent trend, except for we got like a big bump here. But that bump is kind of similar to this first one that we had back in 2012. So, and I'm going to take all this information, I'm just going to project it forward 10 years. All right. And that's basically what my analysis is going to do here. Now, one of the interesting things is over this time period, and this is where I think my basic analysis might need a little adjustment, because the Apple traded at a really low PE for a long time, okay? And the average PE, even including the high PEs of today, is about 15 or 16. The stock has probably permanently re-rated higher. I don't think it's going to stay at 36 for the next 10 years, but it's probably not going to come down to 15 unless we have like a bad recession or something. Okay, so I'm going to I always start by using just the pure numbers to get a baseline, and then I'll go in and I'll say, okay, if that doesn't look reasonable, I'll plug in some other numbers and see what kind of changes that makes. All right, so but first I always like to start off with just what are the numbers telling me, and then I'll say, if something doesn't make sense, then I'll change it a little bit and see if that changes the big picture. All right, so as we saw those little cycles from Apple, they haven't experienced a really normal recession since 2012. So it's possible that you could get a big down cycle here during whenever the next recession comes. I'm not going to include that in this estimate because the recession that we had right now, Apple did great in. I actually don't think that's going to repeat next time. They'll probably definitely have earnings decline during a real normal recession in the future. So again, my estimates are going to be pretty optimistic in terms of not building in a recession downturn at all for the next 10 years. But that being said, they do have moderate earnings cyclicality, and that's how I have them kind of described here. And so the type of analysis I like to use, I call a full cycle analysis that kind of takes in drawdowns and everything else like that. But I don't use it for highly cyclical stocks. So Apple fits the bill here. Using forward earnings on their expected big year, they're trading at a 30 PE. Okay, so a 30 PE, and where their average PE was about 15 this cycle. So if the 30 PE, if nothing changes at all, and the 30 PE just reverts to 15, we would lose 6% a year for 10 years. Okay, that's a really, really big change. Like, it doesn't look like much at first when you see 6%. You got to remember that's every year for 10 years. So it's over 60% drawdown, or 50. You can just kind of look at it and tell it's half. It's like 50% or something. So, what I think is sometimes you just have to look at it and say, okay, Apple, and the story here is Apple's changing to a service company, and there's higher margins with a service company. There's less product cycle issues with the service company with recurring revenue. And so that explains this re-rating from the market right here, okay? The question is whether this whole thing is justified or not. And I would say probably not is obviously where I'm leaning. But still, I think that this is too low. So I think given Apple's growth rate, earnings growth, which is about 11% right now, and that's after a really big year. And I also started this at a really big year. So I think this is pretty generous, 10-11%, but in this spreadsheet, I have it at 11.16. So that's what earnings are expected to grow. For a stock that has earnings growing 10 or 11%, a 30 PE is really high. It's actually about average for the market right now because the market's really high. But usually, even with a brand like Apple's, I mean, you're not going to get that type of growth matched with, well, it's the PEG, right? So this is growth and PE together. So a 2.7 is pretty high. A 2 is probably normal. So for me, look, if they were growing 10% consistently, they have this great brand, everybody loves them, they're very sticky business and all that. Maybe they average a 20 PE. That includes like a recession and everything else that might happen. So that lowers this down a little bit more, okay? And then if we wanted to be even more generous, we could say, okay, a 25 PE seems reasonable. Interest rates are low. You know, this is really generous, I think, for 10% growth to have 25 PE and to be able, on average, for a whole cycle, okay, including recession time. So we can just try 25 here. I want to be as generous as I possibly can, all right? So now the mean reversion, you're only going to lose about 2% a year if just the PE goes from 30 to 25, all right, for 10 years. All right, so now the growth on the fast graphs, the earnings growth, this is EPS growth. That measures from here up to where we just had here, and they have 14%. But I like to take into account share buybacks during this time period, and Apple bought back about a third of the company during this time, and that inflates the PE ratio. So that's part of the reason why my growth rate is lower than the fast graphs. The other reason is I also take into account these 10% down years here. It doesn't affect it a whole lot, but it brings it down just a little bit because it didn't just grow that much every year. It had these down years too. Reality, like again, when we have another recession, their earnings are probably going to drop more than 10%. So I'm being very optimistic here, I think, with everything so far. Okay, so we know the mean reversion. The next thing we want to know is how much we could earn from the business if we just bought Apple's business. Okay, so this takes out all this PE ratio stuff. We set that off to the side. This is just if you bought their business at the current valuation. If you could buy the whole business for $100, and then how much money would you earn from the business, okay, over the course of 10 years, given the earnings yield that you're getting right now. And you could turn $100 into $162.18 at an 11% growth rate, okay, over the course of 10 years. And when you plug that into a CAGR calculator for 10 years, you get a little under 5%. About a 5% return. So the business is basically going to pay you 5% a year, the current price, if they grow at 11%, okay? So that helps you out a little bit because this is negative. So now at least instead of losing money, you're going to earn some money. When this all kind of evens out, Apple trades at a 25 PE, it grows at 11%. It's like 10 years down the road, they're still doing that. You're probably looking at about a 3% return per year. So whenever this is under 4%, that's when it gets into like sell territory for me. And earlier this week, it would have been even lower because the price was higher. But even now after the drop, I mean, you're probably looking at about a 3% return on Apple, unless they come up with some like blockbuster new product and this growth rate ends up being like 15%, 20%, something like that. Then you could see this higher. But I mean, this isn't a good return over the course of 10 years. So that's why it makes sense to take profits in the stock. I mean, it's really that simple. And this is using generous PE here, but I think a fair one. I mean, people love Apple, and it's, you know, going from a 30 to a 25 should be reason. I mean, you could bet that it's going to happen at some point in the next 10 years. So yeah, that's my case for taking profits in Apple. And as I noted earlier, I talked about Facebook being a better value right now if you want something that's somewhat similar, a FANG stock. It doesn't really matter to me that Apple's popular or not. I can go find unpopular stocks nobody's ever heard about, and they can return better than 3% a year. So that's the story with Apple. I like the company. Just like the other ones that I showed over here, Apple will join this list next week. I like these companies, nothing against them, but the market just bid them up too high. So we'll add Apple in there next week, and we'll track it, and we'll see how we do over time. All right, thanks for watching the Cyclical Investors Club YouTube channel. Hit the subscribe button if you found this video useful, and I'll be putting out more videos in the future.